Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the economy in Turkey, or Turkey if you're watching in Turkey. And over the last few months, we've started to see an improvement in terms of the rate of inflation. But does that mean that the economy is now doing well? Well, as you'll see in today's video, unfortunately, it doesn't mean that. But I'm going to go through the details, and also we'll have a look at what the impact of Donald Trump's new tariffs will be on the Turkish economy. We'll see what percentage of Turkey's exports go to the USA and what the new rate that's been agreed is and what impact that's likely to have. But if we kick off with inflation, because I think inflation is probably the biggest topic in Turkey, it's had one of the highest inflation rates in the world for a very long period of time. However, as you can see from this chart, over the last 12 months, things have started to get better. In July of 2024, inflation was sitting at just under 62%. Now, 62% inflation, whilst that's not technically hyperinflation, it is extremely high. If you think about prices year on year going up by more than 50%, then obviously that means that the value of your money is going down and you'd need to be paid a wage increase of around 62% just to be able to buy the same things that you're buying this time last year. However, over the last 12 months, we've seen this constant and gradual reduction in inflation. And the most recent figures for July 25 show that it's now down to 33.5%. So clearly the trend here is very good, but appearances can be deceptive, and as I've pointed out many times before, the scale on the right-hand side of this chart does not start at zero. It actually starts at 32%. So whilst at first glance it looks like this is going fantastically well, you have to bear in mind that inflation is still 33.5% in Turkey. So that's still incredibly high. It means that year on year, prices are going up by a third. So your wages will also be needing to go up at that same sort of rate. So that's not ideal. And if we take a look at this chart, which shows the situation over the past 5 years, it shows that Turkey has had very high rates of inflation since 2022. We're talking in above 30% inflation year on year. And as we've talked about in previous videos, the problem with that is that it builds up a cumulative problem, because if prices go up by 30% last year and then another 30% this year, then year on year, when you look at the 2 year position, they've gone up by around 60%. So basically, what's been happening in Turkey, if you look at this chart, is that every couple of years, prices have been at least doubling, and in fact, more than that in many situations. So 33% inflation, whilst it's an improvement and it's better than where Turkey was this time last year, is still a major problem. And if we look at the month on month movement, so this looks at prices this month compared to prices last month rather than year on year, you can see that the latest data for July 25 shows that month on month prices have increased by over 2%. So if you were to annualize that, if we multiply it by 12 to keep it very simple, I know that's not how it works because you'd have to build in the compounding effect of month on month increases. But just to keep it simple, if we multiply 2 by 12, that gives us, roughly speaking, around about 25% inflation going forward. If inflation was to stay at this same monthly increase, it would probably be closer to 30% with the compounding impact. And if we look at where this has been over the last 12 months, you can see that prices have moved around all over the place. So the figures for July are worse than they were for May and June, but better than they were in April, March and February and January, which was a bit of a shocker when prices increased by 5% in 1 month. And just to put this into the context of all of the other economies in the world, most of the developed world has a target annual increase rate for inflation of 2%, not a monthly increase. So that really puts into perspective the problems that we've got in Turkey right now. Now, before we go on any further today, I just want to ask anybody that hasn't subscribed to smash that subscriber button, because it makes me happier. It puts a smile on my face, but also it does help me with the algorithm, with YouTube. And also, it's nice to have an increasing number of subscribers. So if you haven't pressed that button, please press it now because it doesn't cost you anything. It's just basically saying that you like my videos, and it would basically make me a bit happier. But anyway, if we have a look at this chart, it shows how the current rate of inflation in Turkey compares to the rest of the G20, which are notionally the 20 largest economies in the world. And you can see that Turkey has the second worst inflation rate. Only Argentina has a higher rate of inflation. Argentina is currently sitting at more than 39%. Turkey's the only other one in the 30s. In fact, it's the only other one in double figures. The next highest rate of inflation is Russia, followed by Brazil, Mexico, and then we've got a whole host of countries in the sort of 3s and 2% inflations. And then down at the bottom, we've got Switzerland and China, where they are struggling with the opposite problem of not having enough inflation, which sounds bizarre because nobody wants to pay more for anything. But if you think about it from a company's point of view, if prices are not rising at all, it's very difficult to pass on any of your cost increases. So you have to just basically swallow all of those costs. And that means that your profit margins are going down. And in a lot of companies in China, they are now making losses. So what this table shows us is that Turkey is still an outlier compared to the rest of the G20. And if we have a look at what's going on in the rest of the world, you can see that Turkey is in the top 10 worst countries in the world for inflation. And when you think that it's in with the same, the sort of countries that we're being compared to here are Venezuela, South Sudan, Zimbabwe, Burundi, Argentina, we just talked about, and Iran, it really puts into perspective the serious problems in Turkey. In fact, Turkey's inflation rate is worse than it is in Haiti and Bolivia and Syria and Lebanon and Cuba and Ukraine. So that puts into perspective just how big the problem is. In fact, inflation in Ukraine is only running at 14% compared with 33% for Turkey. So Ukraine's obviously not in a good financial situation right now, but it's doing better than Turkey in terms of the looking at inflation. Now, food inflation is something that I always like to have a look at because it tells us what's happening for the poorest members of society because they're spending a bigger percentage of their monthly budget on food. And you can see a similar trend to what we've just looked at for inflation, where we've got a reduction since November of 24 when food inflation was up at around 48%. It's come down over the last 8 or 9 months. The current rate is just under 30%, which is a positive trend, but it's exactly the same story that we've just talked about for actual inflation. 30% increase year on year in food prices is not good because that means that everybody needs to be paid at least 30% more to just buy the same amount of food that they were buying this time last year. And that isn't happening for many people in Turkey. So what that means is that the poorest members of society are now struggling to be able to buy as much food, to put food on the table. And obviously that becomes a big problem if you have a lot of people who are really struggling with food insecurity. Now, one of the big issues in Turkey with regards to getting the economy back on track is what's going on with interest rates, because they are incredibly high. This chart shows the movements in interest rates over the past 3 years. And you can see that from the middle of 2023 onwards, there was a very aggressive policy of increasing interest rates. So they went up from less than 10% to 50%, which is incredibly high. And you can see that those increases were brought in a short space of time, less than 12 months. And clearly, if you're wanting to borrow money, nobody wants to be paying anything like 50% interest. If you borrow $1,000 and you have to pay $500 per year interest on that, then clearly, if you hold the loan for 2 years, you'd be paying back as much in interest as you borrowed. If you had it for 3 years, you'd actually be paying 50% more than you actually borrowed. They are loan shark levels. In fact, I don't even think loan sharks charge 50%. Well, maybe they do. I don't know. I don't get involved in loan sharks too often. But you can see that those extremely high rates of interest stayed around for about a year. And in fact, even though we've seen some interest rate reductions recently, there was another increase in 2025 back up to above 45%, and it's now sitting at 43%. And 43% in interest rate is still prohibitively high. So, what this is doing is stopping companies and individuals in Turkey from borrowing money. You would be insane to take out a loan in Turkey right now because 43% interest, that's just the base rate. Banks will want to put some profit margin on that, so they might actually increase it to 50%, which we've just talked about. That is just nobody wants to borrow money at those levels. And this is one of the problems in Turkey because to have a healthy economy, you need your companies to be expanding. And not every company has enough cash to be able to pay for a new facility or an increase in its production or to take on more staff. So usually companies will borrow some money ahead of increasing their output, increasing their revenue, and being able to then get the cash and the profit in, and then you can pay back the debt. So that's how things work in a normal economy. If you're borrowing at maybe 2 or 3 or 4% interest, then that's fine. But at 43%, nobody wants to do it. So that means that there's a lack of borrowing for investment purposes in Turkey right now. And also, consumers don't want to borrow. So nobody wants to borrow to buy a car or go on holiday or to refurbish their home or to do anything, basically. So you can only really work with the cash that you have. And that's not a good way for an economy to grow. So these interest rates are definitely hampering Turkey's recovery. And if we have a look at how it compares to the rest of the G20, not surprisingly, it's the highest. So Turkey is right out on its own at 43%. Even Argentina, which has a higher rate of inflation, only has interest rates of 29%. I say only in a very loose term there. It's actually obviously very, very high. Russia is sitting at 18% at the moment, still prohibitively high. And Brazil is the only other country in double figures where it's at 15%. Now, we've got a whole lot of other countries, but nobody is anywhere near 43%. Now, if we can look at how it compares to the whole of the world, the only other country in the world that has a higher interest rate than Turkey is Venezuela. And if you follow the channel, you'll know that we've talked about Venezuela a lot. That economy is completely bossed. It's been sanctioned. It's struggling with regards to its oil. It's got the largest oil reserves in the world, but it can't really monetize them because there are problems with that oil. It's much more difficult to actually refine than Brent crude oil. And also because of the sanctions, nobody's allowed to buy it. So Venezuela isn't really a good benchmark. You don't want to be saying, well, at least we're better than Venezuela, because that's not really saying much. And the interest rate in Turkey is actually higher than it is in Zimbabwe, Argentina, Nigeria, and lots of other countries, or basically every country that you can think of. So that tells us that there is still a serious problem in Turkey. And one of the implications of having high rates of interest is that your debt costs you a lot of money. And this chart shows the movement in Turkey's bond yield, so the cost of Turkey's international debt over the last 5 years. And you can see that it's increased significantly. 5 years ago, Turkey was paying around 14% on its bonds, which is still pretty high. If we talk about the context of the USA, everybody's complaining about bond yields being above 4%, certainly not 14%. But over the last 5 years, we've seen this massive increase to around 30%. And the problem with that is obviously you're having to fund those coupons, you have to pay the interest on your debt. And at 30%, it becomes it's a huge amount of money. So it's a big problem from Turkey's point of view. So that's one of the reasons why high rates of interest are not good for the Turkish economy. Now, in terms of the Turkish lira, we've talked about this a lot, but I thought, seeing as we're talking about Turkey, we'd check in and see what's going on with the lira. And this chart shows the movement over the past 12 months against the US dollar. You can see that 12 months ago, it was trading at around 33 lira to $1. Today, it's closer to 41. So that represents a fall in value of around 23% over the last 12 months. And if we widen the scale of this chart to show the last 5 years, you can see that we've got virtually a straight line here. So 5 years ago, we were talking about $1 trading for 7 Turkish lira. Today, it's 41. And the problem with having a constantly devaluing currency is that everybody loses confidence in it. Nobody in Turkey wants to be paid or hold their life savings in Turkish lira, because if it's going down in value by 23% per year, then clearly you've got a problem. If you thought you have enough money for the rest of your life tucked away in the bank, but all of a sudden somebody tells you it's worth 23% less today than it was last year, and then maybe a further 23% than the previous year, before you know it, your life savings won't be worth much at all. So, for that reason, and many other reasons in terms of purchasing power, people in Turkey prefer to hold euros or dollars or any currency at all apart from Turkish lira. And that becomes a problem for the Turkish authorities and the Turkish central bank because, in order to control the economy and to boost the economy, they need everybody to be on board. So, there's no point increasing interest rates to try to reduce inflation if nobody's using the Turkish lira because the rate increase doesn't actually have an impact. Now, the people in Turkey who are forced to use the lira are anybody that's employed by the state. So if you're employed by the state, you will be paid in Turkish lira. And also there are schemes in place to encourage people to keep their savings in lira. But when you look at this chart, when you look at the devaluation of the lira, it's hard to really buy into that. I mean, it is a big risk holding all of your money in lira when it's constantly going down in value. Now, in terms of what's going on with trade in Turkey, this chart shows the balance of trade over the past 12 months. And the balance of trade is basically the difference between the cost of all of your imports, what you're paying to buy stuff in, and the value of all of your exports, so what you're being paid for everything that you're selling. And the important thing here about this chart is the scale on the right-hand side, which starts at the top at 0 and goes down to minus $13 billion. And you can see that in every single one of the last 12 months, Turkey has run a negative balance of trade because it imports more than it exports. It's a net importer. So basically, it's buying more from everybody else than it's receiving for all of the goods that it's selling. And the figures for July show that the balance of trade was 6.4 billion US dollars negative. So the problem with this, when you have constant cash out, if you're constantly spending more than you're earning, is that it just runs down your cash reserves and puts you in a very difficult situation in terms of investing into the economy and trying to boost things up. Now, I mentioned at the start of today's video that we'd have a look at the importance of the USA from Turkey's point of view. And this table shows the top 10 countries for exports for Turkey for 2024. And you can see that the United States is not at the top. It's actually Germany, which is a strong trading partner for Turkey. Turkey sold over $20 billion worth of goods to Germany. That represented just under 8% of all of Turkey's exports. The United States is the second largest trading partner, and that came in at $16.4 billion, representing 6.2%. Now, the reason I think why that's important is because Donald Trump, as part of his reciprocal tariffs, has now introduced a 15% tariff on all Turkish imports, which in relative terms is pretty good because the base level, nobody has less than 10%. So that's the absolute best case scenario. So 15% is quite good for a country that is still doing a lot of business with Russia. Now, Turkey isn't in BRICS, interestingly, because you thought it may have been, but it isn't. So it hasn't been hit with that additional 10% penalty. But if we look further down this chart, you can see that Russia is actually in Turkey's top 10 trading partners. It exported over $8.5 billion worth of goods in 2024, representing around 3% of all of its trade. So it will be interesting because of Donald Trump's current focus on trying to stop Russia selling anything, because Turkey actually buys a lot of oil and gas directly from Russia. It's very close geographically, and also it's still got friendly relations with President Erdogan and President Putin are quite friendly. So it will be interesting to see whether or not Turkey comes onto the United States radar, and if Donald Trump tries to punish Turkey for continuing its relationship with Russia. But the 15% additional tariff will obviously impact on the 16.4 billion of exports from Turkey to the USA. It will make those exports more expensive. It's likely that there will therefore be a reduction in demand. Some businesses in Turkey will lose some trade, some revenue, so that's going to put further pressure onto the Turkish economy. Now, one of the issues from Turkey's point of view is that it needs to invest into its business. It needs to start making more things, exporting more things, earning more revenue to turn the economy around. And this chart shows the level of foreign investment because, as we've just discussed, with having a negative balance of trade, Turkey doesn't have a lot of money to invest into its own businesses. So it would be helpful if it could bring money in from other countries. Now, as you can see, the latest data shows that the direct foreign investment is down at a pretty low level. It's been at a low level since February, and Turkey is really struggling to attract in a huge amount of foreign investment. And that's a problem because if it doesn't turn things around, if it doesn't try to get its economy going itself, then it will constantly be a net importer, constantly paying out more than it's earning. And so it's always going to struggle in terms of its economy. That will put pressure on the lira. As it devalues, people don't want to use it. And this really becomes a vicious circle. So what's the summary and conclusion today? Well, I wanted to post this video because we've been following what's been going on in Turkey or Turkey for the past 3 years or so. And what we've seen in today's video is that there are some signs of encouragement. We've seen inflation coming down rapidly over the last 12 months. It's come down consistently from more than 60% to around 30% at the moment. And the finance minister recently came out and said that he has a target for the end of 2025 of 20%. He's hoping that it will come down below 20% in 2026 and get into single figures in 2027. So Turkey has a plan to continue tackling inflation. But the problem, as we've discussed, is that 33% is still a very high rate. And when you add in the compounding interest over the last 3 years in terms of all of that inflation, when you're looking at inflation on inflation on inflation, it means that prices in Turkey have got out of control over the past few years. And one of the implications of that is that the value of the Turkish lira has cratered. It's come down in virtually every single month over the past 5 years. 5 years ago, you could trade $1 for 7 Turkish lira. Today, it's more than 40. And the problem with that is that we're having a high level of dollarization. People don't want to keep all of their money in Turkish lira. They want to use other currencies. And that means that the economy becomes fragmented. People are not partaking. They're not taking loans in lira and doing things that other countries would expect to happen in these sorts of situations. So it's a very difficult situation for the Turkish authorities to sort out. And as we've seen from the trading figures, the problem that Turkey has fundamentally is that it's a net importer. It buys more things from the rest of the world than it's selling. And that's a problem because you're constantly out of cash. If you think about that in your own context, if you were constantly spending more than you were earning, you'd have to run an overdraft, you'd have to borrow more money. And the problem that Turkey has is whenever it borrows money, it's paying these penal rates. It's currently paying around 30% on all of its bonds. So that's a problem. And the only way out of this would be for Turkey to invest more into its industry and its businesses in order to grow and expand, then get in more revenue and possibly get to that positive balance of trade situation that would enable it to get back onto an even keel. But the problem that Turkey has is that it doesn't have enough money itself to be able to invest into all of this industry. And so it really needs foreign investment. The problem with foreign investment is when you look at what's happening with the value of the lira, then it makes it very difficult to justify a case of putting lots of money into Turkey right now, because if everything's going to be valued in lira, which it will be because it's in Turkey, then it's likely that values will be going down. The cash flows will be reducing because everything's coming in lira. And so it becomes a very difficult model for any external company to put money into Turkey. So the overall summary of today's video is that whilst we are seeing some signs of encouragement in terms of what's happening with inflation, interest rates have remained prohibitively high. That's stopping companies in Turkey taking on debt and expanding and investing into their own businesses. That means that Turkey really needs some overseas investment. That's not happening at the moment because of what's happening in the Turkish economy. And this really has become a vicious circle that is going to be very difficult for Turkey to break out of. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end. And don't forget, if you haven't subscribed yet, please smash that subscriber button because I'm trying to get somewhere towards 500,000 and appreciate if you could help me. Thank you to everyone that supported me. If you bought me a coffee or sent me a YouTube super thanks or signed up as a patron or a member or a buy me a coffee member, Really appreciate that support. And here's something to put a smile on your face.